Could the future of your golden years, actually be powered by Bitcoin? Or is that simply, well, is it too much volatility for the bedrock of your retirement? Welcome to the deep dive. We're here to cut through all that noise, all hype, and give you the clearest insights on topics that really matter to you. Today, we are plunging into something truly fascinating and honestly incredibly important. We're talking about the recent push to integrate Bitcoin and maybe other cryptocurrencies directly into 401k retirement plans. And look, this isn't just chatter on some online forum anymore. Not at all. This is a complex topic. It potentially affects millions of Americans, trillions of dollars in retirement savings. So our mission today, let's get past the hype, past the fear, give you the unvarnished facts. We want to explore the full landscape, both the, let's be honest, thrilling potential, but also the very serious risks. We'll help you understand exactly what's at stake here as traditional finance really tries to grapple with this disruptive force. We've gone through a whole stack of sources, financial news, research centers, regulatory insights, the important stuff, and we're going to unpack the crucial nuggets for you. So you walk away from this deep dive truly well-informed, ready to think about where you stand. Okay, let's open this up then. We're talking about a policy shift that could fundamentally change how a huge chunk of capital moves in our financial system and what that means for your future, your savings, and yeah, potentially the whole crypto market. This isn't just adding another investment option. It feels like it could be a real paradigm shift.
It really is fascinating. And, what makes this so timely is just how fast this conversation shifted. It went from sort of theoretical musings to actual concrete policy directives almost overnight, it feels like. For years, the idea of crypto in mainstream tax-advantaged retirement accounts, it felt like sci-fi for supporters, maybe a nightmare for regulators. But now, it's not just on the table, it's being actively pushed, even mandated in some ways. But, and this is crucial, like always with big opportunities, there are significant considerations, big ones, and structural challenges too that we absolutely need to examine very carefully, especially when we're talking about something as vital as retirement security.
Absolutely. Couldn't agree more. And that's exactly where we need to start today. This isn't just speculation anymore. It's being driven by a real policy shift, actively opening the door. It's a potential game changer, plain and simple.
Indeed it is. The specific event, the real catalyst here, was that executive order signed by President Trump back on August 7th. And the title itself is, well, it's very telling. Democratizing access to alternative assets for 401k investors. It directly told regulators, hey, expand access to cryptocurrencies, including Bitcoin, within 401k. That language, democratizing access, that's really significant. It signals this intent from the government level to broaden investment choices for the everyday person, moving beyond just stocks and bonds. Cointelegraph reported on this, highlighting the idea of empowering individuals, giving them more perceived control. It's really a political and economic statement, isn't it? Aiming for financial inclusion, at least on paper. The framing suggests a view that limiting options is, well, restrictive, maybe even unfair to people who feel traditional markets haven't worked for them.
And when we say 401ks, we're not talking about play money here. This isn't discretionary spending. We are talking about a truly massive pool of assets, almost unfathomable, really. And it's historically been managed very conservatively, right? Prioritizing stability above almost everything else. This isn't just a few tech folks playing with spare cash. This is the core, the absolute core of retirement planning for millions of Americans.
That's certainly not an understatement. It really hits home. The scale of the capital here is just staggering. You have to grasp this to understand the potential impact. Okay, so the Center for Retirement Research puts the number at roughly $8.9 trillion in U.S. 401k assets. $8.9 trillion. To put that in perspective for you listening, that's bigger than the entire GDP of countries like Germany or Japan. It's this huge reservoir of long-term savings. Now think about what even a modest allocation from that pot could mean for Bitcoin demand. The numbers get pretty wild. Let's just model a couple of scenarios. Remember, even a tiny fraction flowing into a relatively small market like Bitcoin could have huge effects. So if just 0.5%, 0.5% of that $8.9 trillion went into Bitcoin, that's an influx of about $44.5 billion. Just like that. Now, what if it hits 1%? Still pretty conservative for an alternative allocation. Maybe you're looking at $89 billion. And just for kicks, let's push it to 2%. 2% of the total 401k pool, that's almost $180 billion potentially flowing into crypto.
Wow. Okay, $44 billion, $89 billion,
Yeah.
$180 billion. That's not a drop in the ocean. That really is a potential tidal wave of institutional money. What would that kind of capital injection actually do to an asset like Bitcoin with its fixed supply? I mean, beyond just making the price jump initially.
Precisely. That level of institutional flow could fundamentally reshape crypto market dynamics, especially, as you said, given Bitcoin's fixed, scarce supply. Unlike dollars or even company stocks, which can be increased or diluted, Bitcoin is capped, right? 21 million coins, predictable issuance. So such a big, sustained jump in demand, especially from sticky long-term money like 401k, it could put immense ongoing upward pressure on the price. It's basic economics, big demand, limited supply. Cointelegraph, Bitwise, they've both highlighted this. These asset flows could be key drivers. They argue this isn't just retail investors anymore. This is potentially massive, long-term institutional capital finding a significant new home. It's less about short-term bets, more about a fundamental shift in who's buying and holding.
And with that kind of money potentially coming in, I've seen some experts making some pretty eye-popping predictions, really big numbers for Bitcoin's price. What's the thinking behind those forecasts? Are they just throwing darts, or is there a solid rationale?
They are definitely eye-popping. And it flows directly from the scenarios we just talked about. For instance, Bitwise, their major crypto asset manager, we looked at their research, they put out a forecast suggesting Bitcoin could surge towards $200,000, maybe even by the end of the year. Now, that's not just a random guess based on, market mood. Their reasoning is heavily tied to these potential retirement fund inflows. Cointelegraph reported on their thinking. It rests on a few key pillars. First, the sheer size of that $8.9 trillion 401k market. It's just huge. Second, even a small percentage allocation, 1%, 2%, translates into those massive dollar figures we mentioned, tens or hundreds of billions. And third, that inelastic supply of Bitcoin we keep coming back to. So you combine a potential surge in demand from a whole new historically conservative group of investors with a supply that just can't easily expand to meet it. Well, the price discovery mechanism tends to lean strongly towards significant appreciation, upwards. Plus, some see this inflow itself as a legitimizing force, like a stamp of approval.
It could signal to other big institutional players that crypto is becoming more mainstream, more regulated, potentially creating this feedback loop, right? More adoption, more demand, higher prices. It's a very bullish case, yeah, built on those twin engines. Massive potential capital flow and that inherent scarcity.
Okay, so beyond just the price going up, which obviously catches headlines, are proponents arguing that Bitcoin could actually bring other, maybe more subtle benefits to a retirement portfolio, things beyond just chasing those big gains?
That's a critical question, absolutely. And it's where the core investment case for adding Bitcoin to a diversified portfolio really starts for many people. Sources like Axios, Cointelegraph again, they highlight arguments that Bitcoin can be seen as a non-correlated asset. Now, what that means for you listening is that its price movements don't necessarily follow the same path as traditional things like stocks and bonds. Usually in your portfolio, if stocks dip, maybe bonds go up a bit, providing some balance. But sometimes, in major crises, everything kind of drops together, right? They become highly correlated. That undermines your diversification. Bitcoin, historically anyway, has often seemed to march to its own beat. Why? Well, people point to its unique drivers. That fixed supply, tech advances, the global adoption story, sometimes even seen as a geopolitical safe haven. Things that often operate independently of traditional economic cycles or what central banks are doing. So this non-correlation could theoretically add some upside and maybe even stability. It could act as a genuine hedge or at least a different source of returns when your other assets are struggling.
The thinking is passive flows from retirement accounts could help smooth out your overall portfolio returns over the long run, making you a true diversifier, not just another volatile stock tied to the S&P 500. Stepping back, it's really about trying to build a more resilient portfolio, one that can handle different market weather, unexpected shocks, by including an asset with fundamentally different risk and reward characteristics. But it's also fair to point out, during really extreme global stress, like major liquidity crises, Bitcoin has sometimes shown more correlation with risky assets, which raises a big question for the people managing these plans, the fiduciaries. How reliable is that non-correlation when things get really ugly? And what's the right amount to allocate to get the benefit without adding too much systemic risk? That's where the debate gets really heated.
That definitely makes a compelling case in theory. Diversification, potential for huge growth. But it immediately brings up that critical question for millions of savers, doesn't it? Can Bitcoin, with its history of just wild price swings, truly be trusted with the bedrock of your retirement? Is that potential upside really worth the psychological and financial roller coaster of its volatility? That's the other side of this coin, the perilous path that we absolutely have to dig into next. Welcome back to the deep dive. We've just explored the frankly exciting potential of putting Bitcoin into 401k, policy shifts, opening doors, huge amounts of capital potentially flowing in, the promise of diversification. But as with any investment that promises big upside, especially something as new and, let's face it, volatile as Bitcoin, there's always another side, a more dangerous side. And that's especially true when we're talking about something as absolutely critical as your retirement savings.
Absolutely. That enthusiasm, those bullish forecasts, they need a serious reality check. a clear-eyed look at the risks involved. And experts are issuing some pretty strong warnings. It's vital for anyone thinking about this to understand them, not just as abstract ideas, but as real threats to their financial future. Alicia Manel, she's from Boston College, a leading voice on retirement policy. She's one of those experts. Her warnings are echoing across the financial world. She characterizes Bitcoin as fundamentally speculative. That's her word. And she emphasizes it starkly lacks traditional cash flows. Think about it. Unlike a company paying dividends from profits or a bond paying regular interest, Bitcoin doesn't produce anything tangible in that way. It's not generating income. So that lack of fundamental valuation metrics, combined with its inherent well-documented volatility, it makes it a deeply risky foundation for most retirement portfolios. That's the argument. Traditionally, retirement savings are built carefully, right, on assets that generate income or have more predictable growth tied to the economy. Bitcoin's wild swings, sometimes massive drops or surges seemingly out of nowhere, reported by the Financial Times, Cointelegraph, AARP. It just introduces a level of uncertainty, a level of risk, that most retirement planners, most fiduciaries have historically avoided. And for good reason. It feels less like investing in a productive asset and more like betting on market sentiment and future adoption trends.
Okay, and when we talk volatility, I mean, we often focus on the big drops, the scary headlines. But some might argue maybe for a long-term retirement plan, the potential for fast recovery or even exponential growth kind of balances out that risk. How do you weigh that view against the instability?
That's a fair question. It really gets to the heart of the risk-reward debate. But, when it comes to retirement, the stakes are just fundamentally different than, say, playing around with some money in a separate brokerage account. Let's try to put Bitcoin's volatility in perspective. Think about typical 401k funds. A well-diversified stock fund built for long-term growth, maybe it swings 15%, 20% in a really bad year. Bond funds, the traditional safety net, much less volatile, maybe just a few percentage points a year. Bitcoin, on the other hand, historically, we've seen price swings of 50%, 70%, even 80% or more, sometimes within a single year, sometimes just a few months. Remember that 2021-2022 bear market. Bitcoin dropped over 70% from its peak. That kind of drop is something a traditional stock fund might see over, a decade of terrible performance, not just a few months. So just imagine for a second, waking up one morning, checking your 401k, and seeing a big chunk of your life savings down 30% or more. That's not just numbers on a screen. It's a deep psychological gut punch. And most traditional 401k investors are just not emotionally prepared for that, let alone financially if they're nearing retirement. Yes, there have been incredible recoveries, but the ride has been anything but smooth or predictable. This massively different risk profile just fundamentally changes long-term retirement planning, which usually prioritizes preserving capital and steady compounding growth over those extreme highs and lows. It truly is a roller coaster. Maybe okay for a small speculative side bet if you have a high risk tolerance, but potentially devastating financially and emotionally for your core retirement savings. It really begs the question, is that promise of extreme upside worth the potential for that kind of profound stress and the severe risk to your capital?
Right. Beyond just the price going up and down like a yo-yo, what are the other, maybe less obvious practical risks, the nitty-gritty stuff investors might not think about when they just hear Bitcoin for retirement? What are the hidden traps here?
That's a crucial area to explore, because the risks definitely go beyond just price swings. There are several real practical dangers lurking under the surface, and it's absolutely critical for anyone considering this to understand them. Drawing from sources like CBS News, Cointelegraph, todayonchain.com, we can flag a few key problem areas. First off, high fees. This is a big one, often overlooked until it's way too late. Crypto products, whether specialized accounts, managed funds, even the new spot ETFs, they often come with significantly higher fees compared to the super low-cost index funds you usually find in 401k. These higher fees, even if they look like small percentages, they compound over decades. They can dramatically eat away at your long-term gains, quietly draining potentially hundreds of thousands from your retirement nest egg. We'll dive deeper into fees later, but it's a major red flag. Second, cybersecurity exposures. This is a constant evolving threat in the digital world. Crypto's nature makes it vulnerable to all sorts of things. Sophisticated hacks of exchanges, clever phishing scams trying to steal your login or your private keys, and even just losing access irreversibly if you mismanage your own keys or seed phrase. Unlike your bank account with FDIC insurance, or a brokerage with SIPC protection if your crypto gets stolen or lost, it's usually gone forever. Unrecoverable. We've all heard horror stories, people losing life savings to scams, lost passwords, compromised exchanges. This demands a level of digital security awareness and technical responsibility that most 401k investors just aren't used to. Third, and this is huge for employers, is the issue of fiduciary liability. The plan sponsors, the companies offering these 401ks, They have a legal duty under ERISA to act solely in the best interest of their employees, the plan participants. So offering Bitcoin without really robust risk education, without stringent vetting, without meeting incredibly high fiduciary standards, it could open them up to serious legal trouble. Imagine employees losing huge amounts due to Bitcoin's volatility, or if there are operational screw-ups with crypto custody or valuation. Those plan sponsors could be sued. The Center for Retirement Research points this out as a major reason many businesses are hesitant. The legal and reputational risks are just massive. And finally, just the sheer complexity of crypto mechanics themselves. It's not simple stuff. You've got concepts like staking, locking up crypto to earn rewards, which has its own risks like slashing or impermanent loss. Understanding hard forks, big protocol changes, creating new coins, needing careful management. Navigating DeFi, decentralized finance, with its experimental protocols and smart contract risks, or even just the incredibly complicated tax treatment. Converting crypto, getting staking reward, these can trigger taxable events. These are not simple ideas for the average 401k investor to just pick up. Nor are they easy for traditional plan administrators to track. It makes you wonder, how ready is the average person for this level of technical detail? Especially when many just want to set it and forget it retirement plan. This isn't like buying a simple mutual fund. It requires a much deeper understanding and active management to do safely.
Wow. Okay, that paints a picture of some really substantial practical and technical hurdles. It sounds like it's not just about the asset itself, Bitcoin, but also the entire system, and to hold it, value it, manage it. I mean, the infrastructure for traditional 401ks took decades to build and refine. Can these old systems just adapt? Can they handle something so fundamentally different?
You're hitting the nail on the head there. The reality is current 401k infrastructure just was not built for crypto, not even close. And this creates a whole bunch of fundamental structural gaps that you can't just patch over easily. Cointelegraph, A-Invest, CBS News, they all point to these deep-rooted problems. Let's break them down a bit. Custody, for example. Securely holding digital assets is worlds apart from holding stock certificates in a vault or entries in a brokerage account ledger. With crypto, it's all about private keys. Does the investor hold their own keys? That means immense personal responsibility for security hardware wallets, seed phrases, operational security, stuff many find daunting. Or do they rely on a third-party custodian? That introduces different risks, trust, counterparty risk. What if the custodian gets hacked, goes bankrupt, mishandles funds? This counterparty risk is a much bigger concern in the crypto world compared to the highly regulated traditional finance custody systems with their audits and capital requirements. The rules for crypto custody are still being written, frankly. It's a patchwork. Then there's real-time valuation. Traditional 401ks usually value assets once a day.
Maybe even weekly, based on closing market prices. Simple enough, crypto. It trades 247 globally on countless exchanges. Prices whipsaw constantly, second by second. How do you reconcile that nonstop real-time volatility with the slow periodic valuation of a 401k? It's an accounting and administrative nightmare. Makes accurate daily net asset value, NAV calculation for the fund, incredibly difficult, maybe even misleading. It messes up rebalancing, contribution timing, everything. And finally, tax events. The sheer complexity of crypto tax rules.
Oh, boy.
Capital gains on trades, how forks are taxed, staking rewards, cost basis tracking across multiple buys. Existing retirement plan systems are absolutely not equipped to handle this granularity, these often ambiguous crypto tax nuances. It could inadvertently trigger unexpected tax bills for investors inside what's supposed to be a tax-advantaged cocoon. Without crystal clear guidance and systems built for this, investors and plan admins are walking into a compliance minefield.
So it's really not just a tech problem you can fix with a software update. It sounds more like it needs a whole overhaul. New systems, new regulations, the works.
Exactly. That's the core of it. The current infrastructure readiness indicators, they scream that we need entirely new digital asset ready systems for safe, secure, efficient, and compliant crypto support. This isn't a tweak. It's a massive undertaking. We're talking fundamental upgrades across the board, developing new, super secure custody solutions specifically for digital assets, implementing real-time valuation methods that can actually reflect the 24/7 market accurately, overhauling record-keeping systems to handle blockchain transactions, forks, staking rewards, and on top of that, new regulatory frameworks are desperately needed. Clear rules for fiduciary duties, consumer protection, operational standards in this new space. Without these fundamental systemic changes and a clear regulatory roadmap, integration will be messy, insecure, ripe for mistakes and scams. So yeah, on a readiness scale, it's currently very low. It's a monumental task. It needs huge collaboration between regulators, banks, crypto tech firms, and it'll take a lot of time and money to get right.
And for the people actually responsible for these plans, the employers, the fund managers, the trustees, the stakes seem incredibly high. Given all these new risks and the shaky ground of regulations, what exactly is this fiduciary minefield you mentioned earlier? How does that play out?
They are indeed incredibly high. And this brings us right back to that fiduciary minefield. Under ERISA, remember, the Employee Retirement Income Security Act, the folks managing 401ks, have this fundamental legally binding duty. They must act solely in the best interest of the participants. That means making prudent investment choices, diversifying assets to minimize big losses, ensuring fees are reasonable, the basics of responsible stewardship. Now, advisors and lawyers, Cointelegraph and the Center for Retirement Research cite them. They're warning that just offering Bitcoin in a 401k carries huge legal and financial risks for these fiduciaries. Think about it. If plan sponsors don't provide really good risk education, clearly explaining Bitcoin's volatility, the security risks, the fee structures, or if they don't follow robust, clearly defined standards for picking and managing these crypto options, they could face serious lawsuits, especially if participants suffer major losses, or if there are operational errors with custody or trading. The idea of prudence under ERISA is usually judged based on traditional well-understood assets, stocks, bonds, mutual funds. Introducing Bitcoin with its unproven long-term track record in retirement plans, its extreme volatility, its unique operational headaches, it significantly raises the bar for what counts as a prudent decision. This threat of litigation, damage to their reputation, regulatory crackdowns, it adds a very real layer of hesitation for employers and plan fiduciaries. They're ultimately responsible if things go sideways. It forces them into this tough spot, weighing the demand for access against their core legal duty to protect employees' retirement nest eggs.
It is definitely a lot to weigh, that's clear. To really get a handle on this whole landscape, it's always useful to look around, right? See how similar things have played out or how other places are tackling it. Are there any precedents or comparable situations we can look at to shed a bit more light on this complex picture?
Absolutely. Looking at precedents in similar situations can give us really valuable clues about where this might be heading and what pitfalls to watch out for. Let's start by making a really crucial distinction between Bitcoin ETFs and direct 401k inclusion. They sound similar, but they're very different beasts. Bitcoin ETFs, those exchange-traded funds that finally got regulatory approval in 2024 and gained a lot of traction, they definitely made it easier for many investors to get Bitcoin exposure. But how they did it is key. You bought shares in a regulated financial product, a fund that holds Bitcoin, so you were a shareholder in the fund. The ETF wrapper provided a layer of professional management, some regulatory oversight, even if indirect, and integration into your regular brokerage account. You bought a share of the fund, not the Bitcoin itself directly. Now, 401k inclusion as is being proposed, that could bring millions of savers into direct asset exposure, holding Bitcoin or other cryptos right there in their retirement account. That's not just buying shares in a managed fund. It means a direct relationship with all that heightened volatility we talked about.
Direct exposure to the unique security risks of digital asset custody. Direct grappling with the operational complexities of the underlying asset itself, not buffered by a fund manager. It's a significantly different level of engagement. It requires a much deeper understanding of Bitcoin's nuances, security needs, tax rules, than just buying an ETF share, which really makes you wonder, how much personal responsibility are investors truly ready for here? Especially those who aren't financial experts or prefer a hands-off retirement strategy. The directness of the exposure really changes the game for risk.
And this isn't just happening in the US, right? You mentioned other countries are seeing similar interest in crypto for retirement. Suggests it's a broader, maybe global shift in thinking.
That's a critical point for perspective, yes. It highlights this isn't just some isolated American quirk. We are definitely seeing a global shift in how people think about and want to invest their retirement money. There was a recent survey from the UK Investopedia, Cointelegraph, A-Invest all mentioned it, found that quite notably, 1 in 4 UK adults are actually open to having crypto in their retirement funds. And even more striking, of that group, the ones already open to it, over 40% said they'd even consider pulling money out of their existing pensions to put into crypto. Now, that's not just passive curiosity. That's a strong signal of a rising mainstream appetite, a willingness to take real action, maybe even disrupt long-term savings plans. This trend likely points to a few things happening globally, maybe younger generations more comfortable with digital assets, maybe some cynicism about returns from traditional pensions, especially in low-interest environments, maybe even eroding trust in traditional finance after past crises. But this mainstream enthusiasm often comes without a full grasp of the risks involved, especially compared to maybe U.S. investors with more established 401ks and different regulations. It means regulators everywhere are going to be wrestling with this. How do you balance innovation and investor demand with absolutely essential consumer protection?
It's a global challenge unfolding now.
Okay, so given that global interest, are there any existing models or vehicles we can actually look at? Something that might give us a hint of what this could look like in practice? Or maybe even serve as a cautionary tale, perhaps, something to avoid repeating?
Yes, there is one, and it's an important one that offers some pretty sobering insights. Bitcoin IRAs. These already exist. They let individuals hold crypto within a self-directed individual retirement account. And they give us a practical look at some of the challenges that could easily pop up with broader 401k integration. Both the Center for Retirement Research and Cointelegraph highlight that these Bitcoin IRAs often charge extraordinarily high fees, way higher than traditional IRAs holding normal funds. We're talking setup fees, transaction fees, monthly maintenance fees, maybe even storage fees, all aggressively eating away at long-term returns. Plus, they have specific contribution limits, and frankly, many financial experts generally advise against using them for long-term retirement, primarily because of crypto's volatility and the sheer complexity of managing these assets inside a tax-advantaged account. The administrative hassle, the need for self-direction, the often murky and expensive fee structures, they can be real roadblocks. So this really serves as a kind of poor precedent for 401k.
It strongly suggests that just dropping crypto into existing retirement structures, even self-directed ones like IRAs, isn't a simple fix, and maybe not even beneficial without huge adjustments and safeguards. Without a total rethink of fees, admin processes, and a massive investment in investor education and protection. The Bitcoin IRA experience warns us that widespread 401k inclusion could lead to similar problems. High costs draining savings, and investors exposed to risks they don't fully understand or manage well. It's a stark reminder. Just giving access isn't enough. Beneficial access needs smart design and tough oversight.
Let's really put some hard numbers to these ideas now, especially breaking down the financial impact of those risks we've discussed, like those high fees you just mentioned. This is where it hits home, right? Where it directly affects how much your retirement savings actually grow over time.
This is absolutely where the rubber meets the road. Because fees, they're often overlooked when people are excited about potential returns, but they have this devastating long-term impact. It's the power of compounding working against you. Let's contrast it clearly. Average traditional 401k fees, they're typically quite low, around 0.26% per year, give or take. That usually covers admin costs, record keeping, and the fees for the underlying low-cost index funds or ETFs. It's a lean machine, built over decades to preserve capital and maximize growth. Now compare that to crypto product fees, the difference is just stark. Bitcoin ETFs, which are already seen as a more cost-effective way to get exposure, they might charge anywhere from 0.95% to 1.5% annually. But specialized crypto accounts may be offering fancy custody or trading features. They can have even higher fees. We could be talking percentages several times, maybe even 10 times higher than traditional 401k options. Today on Chain.com, Cointelegraph, and Invest all report on this. What's truly revealing is how fast these seemingly small percentage differences demolish your retirement savings over decades.
Let's just run a quick hypothetical for everyone listening. Imagine you start with $100,000 in your 401k. Let's say it grows at an average of 7% per year before fees. After 30 years with a traditional low 0.26% annual fee, you might end up with around $730,000. Pretty good. Now take that same $100,000, same 7% gross return, but invest it in a crypto option charging a 1.5% annual fee. After 30 years, you'd only have around $600,000. That difference, just 1.24% in fees each year, compounded over 3 decades, it could cost you over $130,000 in potential growth. Gone. It's this silent killer of wealth. Unnoticed day to day, but devastating over the long run. It's not just about what you earn, it's about what you keep. And these high fees really hit that hard. It demands a much cheaper, more transparent structure if this is going into retirement plans.
Wow, that hypothetical really drives home the fee impact. Okay.
Yeah.
So if we had to sort of grade the current financial system, its readiness for crypto, especially in 401ks, where do we stand? It sounds like there isn't just a gap. There's more like a huge canyon we need to cross.
A critical canyon is a good way to put it, yes. If you were to chart it out current traditional systems versus what's needed for secure, efficient, compliant crypto support, you'd see this massive chasm. Custody, like we said. Traditional relies on banks, ledgers, paper trails, assumes physical possession. Crypto demands cryptographic security, complex key management, specialized digital custodians. The frameworks just don't match up. Valuation. Traditional is daily or weekly, based on regulated closing prices. Crypto is 247, global, volatile, across countless platforms. Getting accurate real-time values for a 401k in that environment. Huge accounting challenge. Needs new data feeds, reconciliation, audits, record keeping. Existing systems track stocks and bonds with standard identifiers, transfer agents. They're totally unprepared for blockchain transaction histories, forks, staking rewards, smart contract interactions. So no, it's not a simple tech upgrade. It's a fundamental regulatory, operational, and technological overhaul needed across the whole retirement ecosystem. We're talking brand new systems, new protocols to handle digital assets, properly secure keys, real-time reconciliation, complex tax reporting.
Until those systems are built, tested, and robustly in place, the path to putting crypto safely in 401ks is just full of challenges. Makes it a very low grade on readiness right now. It's a monumental job. Needs regulators, banks, crypto firms working together like never before, and it's going to take serious time and money to mature into something truly reliable and safe for millions of savers.
Okay, all of this really brings us back to some big picture questions. Questions that you, our listener, will ultimately need to think about. Could putting Bitcoin in 401ks actually trigger a massive market move, maybe even that $200K price? Or could it risk crashing everything if a really bad bear market hits those retirement accounts hard? And maybe more fundamentally, should retirement accounts be made crypto ready? Should we embrace this innovation? Or should they be rigorously kept safe and stable, sticking only with traditional, well-understood assets? These aren't easy questions at all, and the answers have huge implications, both for your personal finances and the wider economy. So after all that, what does this mean for you? Today, we've taken a really deep dive into this fascinating but, incredibly complex world of Bitcoin and 401ks. We've seen the powerful potential massive capital inflows, maybe diversification benefits driven by policy shifts aiming to democratize access, but we've also stared squarely at the serious, often hidden risks. From that extreme volatility that can wipe out savings, to those alarmingly high fees compounding over time, to very real cybersecurity threats, and this challenging regulatory and infrastructure landscape that just seems, well, far from ready. Stepping back, what this really shows is that it's not a simple yes or no. Not at all. It's this complex, ongoing balancing act between the desire to open up access to potentially high-growth, innovative assets and the absolute fundamental need to safeguard the long-term financial security of millions and millions of Americans. This conversation is really just starting. The systems needed for safe, efficient, fair integration are still very much evolving, still being figured out. There's this real tension, you can feel it, between pushing financial innovation forward and the essential need for investor protection. And it's playing out right now, with your retirement savings potentially caught in the middle.
As you consider all this information we've unpacked today, we want to leave you with this thought to mull over. If you really want exposure to crypto in your investments, isn't using a Roth IRA or even just a standard brokerage account maybe a safer, more transparent, and arguably more flexible way to do it right now? A way that lets you manage that specific risk without tying it directly to the absolute bedrock of your core retirement savings in your 401k. And that brings up maybe an even more critical point. How do we make sure that this whole push for democratized access doesn't accidentally lead to greater risk, potentially devastating losses for the very people who are maybe least equipped or least informed to navigate the complexities and the pitfalls of these volatile digital assets, especially when it's their retirement security on the line?
If this deep dive helped clarify how Bitcoin and 401ks could reshape investing or maybe fundamentally change the risks in retirement, we'd really love for you to engage with us. Liking this video, subscribing to our channel, hitting that notification bell, it genuinely helps support the deep dive a lot. Your engagement actually boosts our visibility in the algorithm, lets us keep bringing you smart, timely, unbiased analysis on the big topics shaping our world. We're here to help you stay well-informed, and truly your support is what ensures we can keep doing this mission. Thanks for diving deep with us today.